When was the last time you reviewed your life insurance policy? In the past, people purchased these insurance policies and put them into a drawer never to be seen again. But now they've come to find that in some instances, their policies are not performing the way they had expected. What do I mean by this? You may have purchased a policy that was supposed to have an annual premium payment for 7 years, let's say, for example. And when you purchased that policy, you may have been under the impression that the premiums would end at that time, not realizing that it may have been based on an interest assumption or a dividend rate. Now you've come to find that the insurance company continually sends you premium notices, and what was once a 7-pay policy has turned into a 20-pay policy. Maybe you have an old universal life policy. This policy was originally structured to last through age 100, but now it only goes through your age of 86. What is somebody to do? Well, while we can certainly sit with you and show you how to restructure that policy, the alternative is to see which approach is less expensive, restructuring what you have, or seeing if we were able to take the cash value out of that existing policy, utilize a 1035 tax-free exchange to another insurance company, and see which premium structure would be less. If the new policy is less expensive, by all means, go with it. If, on the other hand, you are able to restructure your existing policy, then we will make our recommendations to stay put. Other ideas include seeing if you can reduce your annual premium outlay, or if you might be able to increase the amount of death benefit you currently have without increasing that annual premium. Now, let me give you one quick example of somebody who was able to optimize their existing insurance. Recently, we had a couple who had a $6 million insurance policy. They actually had a loan with it. It was a whole life insurance policy. The loan had brought the death benefit down to $5.4 million. And since they had no intention of ever paying another premium to that insurance company and not paying any interest on the loan, the interest kept building up, then the death benefit kept reducing. So what was the bottom line? By the time they were 90, that death benefit had been reduced to about $3 million. At age 100, it was below $2 million and kept going down the longer they lived. What was the alternative? We showed them how to transfer the cash from one company to another insurance company. That company assumed the loan, and at that point, they were able to buy approximately $5.5 million of insurance that was guaranteed to last through their age of 100 without putting up any additional monies. The bottom line, once again, was instead of having a decreasing death benefit, which is what they currently had, they now have a level death benefit for what they were supposed to have from day number one. Let us take a look at your existing policies and see if we can optimize them for the benefit of your family.